everyone, and welcome to the new episode of Senzal Insights. Today, I have my special guest, David Orr, who is with me again, and I'm really happy to have you again, David.
Yeah, I'm glad to be on it. I liked the interview last time. Good times.
First of all, I would like to recommend everyone to go to the first interview we did together. This one is going to be a bit different. We are going to focus more on the strategy and investing. In last one, we spoke about David's ETF, a really interesting one that's basically doing a long short strategy. So, first of all, what's really interesting from our last conversation, there's 2 points. First of all, is that you had a successful poker career. So I would like to ask you, do you approach investing like poker? For example, you have two aces. Do you have companies that you see as having two aces from like probability perspective? I mean, if you have two aces, you're basically your chance of winning is much higher than having two and seven. For example, do you like buy two aces and short two and sevens, or and do you like, I mean, in poker, everything is like in probabilities. And are you looking at it like from probability perspective? I'm going to buy, because you have a lot of holdings. You have like few hundreds of holdings, if I'm not mistaken. Are you like, okay, this has higher probability, I'm going to allocate more. This has lower, I'm going to allocate less. I mean, do you see it as a poker in some way?
Yeah, I think for me, I'm just trying to guess like the um, expected value of the bets, which is a poker way of thinking about it. Um, you know, poker player doesn't think too much about sort of just the hand, the pre-flop strength. So just because you have two and seven and ace ace, I mean the two and seven, you're just going to fold every time. So you don't even really think about that one, but you have a marginal hand, right? And sometimes you're forced to play these in some spots. And then, yeah, you get into a tricky, tighter spot. So, but the nice thing about investing that's a lot different than poker is you never have to play those, right? So that's what makes investing like, I think investing's way easier than poker. Poker, you just, anytime you're in a marginal spot, you have to make the razor sharp, perfect decision because that's really where the real edges are. In poker, playing ace as well is very easy. You just sort of bet a lot, and then unless like if the board comes out badly enough, then there's like four to a straight and there's four to a flush out there, and you don't have a flush or a straight and you have aces. That's no longer a strong hand, but it's obvious. Um, but but besides those kind of spots, aces are really easy to play. You just sort of keep betting and putting money in, and then if you can find a company like that in the stock market, it's good. But you can't just bet like that much on it either because you still have a chance of losing no matter how good the setup is, right? So you just have to go find as many of those strong hands as you can find.
And can we say that, for example, Nvidia and in general, big tech is basically like having two aces. You have high probability of winning, but at the end of the day, it could go wrong, especially right now.
I don't think that would be. I mean, I'm long like Amazon and Taiwan Semiconductor and a little bit of Google, but I don't know if I'd call those two aces kind of hands. Because for one thing, like they're really correlated to the market, and just the fact that they're correlated to stocks generally lowers at least for what I do, because I run the high leverage portfolio where correlation matters a lot. Um, that automatically means that they're not the best thing you can find. Because what I'm looking for is something that's both got like a really high edge, hopefully even higher than those are good companies. I think they're going to win long term as a basket. But you're hoping for something with an even higher edge and that's uncorrelated. And then that's what I would consider sort of the two aces sort of strength company with no downside risk or not that much downside risk, preferably. But even if it's uncorrelated, the downside risk portion of it actually even matters less, because it matters if your downside is correlated to everything else. But if you have a one-off sort of horrible situation, but nothing else is going wrong, it's actually completely fine. So that it's all about the expected value. If the correlation's low, so that's the best setup you can have, is a high expected value, low correlation bet. Um, and then big tech, that's just like a good, reasonably strong hand or whatever, and it's easy to bet on some. But you asked for sort of a poker comparison. So if you wanted to sort of protect yourself in poker, you wouldn't want like only pocket queens or whatever with your entire portfolio, because sometimes the board comes out with an ace and a king on it, and then
Yeah,
you're screwed. So you know what I mean. And then so yeah, and so I see it like, yeah, you just want sort of a mix of different kinds of bets. And I think big tech is a really easy one to be long. I think everyone should be long some big tech today for sure. But is it that strong? Maybe not that strong.
yeah. I mean, that's you made a multiple great points, and thank you for that. And I mean, yeah, I completely agree. Especially when it comes to Taiwan, for example, with geopolitical risks, you simply never know if you're going to wake up and be down 10% or whatever first
Yeah.
move or whatever. So
Mm-hmm.
it's but as you said, I mean, but you see everything from the point of probabilities.
Yeah, you're just looking for, so expected value means you're just comparing, like how much you're going to win on the bet in the long run. You're going to lose sometimes, you're going to win sometimes, but if you just sort of average out the long-term expected result there, you're just looking for things that have a really high win rate. And then,
And
if you find enough of those that aren't all correlated to each other, because some guys think they have like a portfolio of stocks and they're just long the Magnificent Seven, and they're like long 80% of that stuff. And it's like, okay, but that's sort of not actually that many different bets. They're all going to be super correlated. So,
exactly, yeah, and 0.8, 0.9, or even more. I mean, really strong correlation between pretty much all of them. And for example, what's really interesting is, I mean, even crypto right now has a. I mean, it didn't have like a month ago when it was Bitcoin at 70 something thousands, and correlation for some time broke off. But I mean, it's pretty much when we have a longer horizon, it's pretty much the similar positive from sometimes strong
yeah,
or
in April the correlation of Bitcoin broke down because of the
yeah,
specific news. And what happened was, Chinese people wanted to get their money out of China, so they started buying lots of Bitcoin, and the market was melting down, and Bitcoin didn't drop at all. So that's why that happened. And um, if the trade war escalates again, it'll probably happen again.
yeah. But then we had this situation with Iran, and Bitcoin was again really weak, and
Yeah.
I mean, it still needs some time to. I mean, it's hedged from financial markets, let's say, or some kinds of situation, like you said, with China. But on the other hand, when there's global tensions and global wars, I would expect it to go up, not to go 2 times or 3 times as much down as Nasdaq, for example. And
Mhm.
how do you manage to follow all those positions? I mean, you published your setup on X few months ago, and it was like basically you have at the time you had Coifin and few apps, but you no Bloomberg terminal, no some kind of special software, or I mean, how do you keep a track of that? And
I
you're
don't think
telling us
that.
that you don't need, for example, terminal and hundreds of thousands of dollars of different subscriptions to actually do really well and have your own hedge fund.
Yeah, I think that stuff gives you a negative edge. You're plugging into the same few things that every other hedge fund manager is plugging into, and you're getting the same data feed and everything. And this isn't actually helping you. It's actually probably hurting your edge, and you're paying for it. That's how I see it. I think if it's used like in a disciplined way, maybe because the one benefit that Bloomberg has over what I have is it's got better debt data. You can see
Yeah.
where some debt is trading. I wish I had that data, but besides that, you can get all the same information that you need for free. And now AI actually makes it really easy, even probably better than a Bloomberg, because now like I have the Japanese filings of all the companies I'm following. Like I just get alerts of every single filing for every single Japanese company, like a bullet point summary automatically translated into English. They get delivered to me every day. So I just sort of go through a handful of those every day, and it takes me just a few minutes. Uh, you don't need to pay Bloomberg $30,000 a year for that or anything like it. It's free.
But how do you monitor the correlations between all of your holdings? I mean, you have a lot of shorts and a lot of longs. You're like 200 something. I mean, I don't know right now what you are, how much are you long and how much are you short, but pretty much you are deep into leverage and you have a lot of like probably minus 200 shorts and plus 200 or 250 longs.
Yeah, right now I'm at a bit over 400% gross leverage.
Gross,
And
yeah.
then in my partition, it's a bit over 300 positions. So uh, so like for shorts, I just have these correlation buckets in my watch lists, and I know which correlation bucket each short belongs to. And there's not that many. It's not really that hard.
Yeah,
So like I actually have them based on industry or theme. So for example, I'm short traditional like linear television, and I'm just short a basket of those kinds of companies. I'm short like crappy offices. Those are really like interest rate sensitive. So you sort of have to know that that whole bucket is sensitive to
yeah,
rates. Part of why I'm still long a bit of them. They're not as good fundamentally today, but the home builders is because they hedged those rate sensitive shorts perfectly. So, but yeah, and then you just keep having more of these buckets. And then the scariest bucket on shorts are just the crowded shorts.
yeah.
And I have zero of those. I don't short any of them anymore. And that makes everything way easier because that's where the big problems arise. And then if you're managing a portfolio of 300 stocks and then you're putting out a fire on a crowded short every day, it's really distracting and takes up a ton of your energy. So I just avoid that whole situation. Instead, I'm short these sort of boring companies that nobody ever talks about. The thesis is like a few sentences long. I don't get them all right, of course, but if I'm right 60% of the time on the thesis and it's a 0.4% bet, nothing's ever really happening. The stock doesn't even really move around at all, nothing. And then once I have the thesis, that's pretty much it. And I can be short the thing for 2-3 years longer. And I don't even really look at it.
But
So,
do you add because when you are when you are long, what a lot of people don't understand is that when you are long, your positions gets bigger, but when you are short and you are earning money, your position basically gets smaller. So
mm,
do you add money on the winning shorts and
yeah, I do.
do you cut losing ones?
Yeah, I do both of that a lot because, especially for tax reasons, you want to let the winning shorts run. It's really a huge tax mistake to quit a winning short. Let's say it's down 60% already. And unless you have sometimes you have a good reason, but usually there's not actually a good reason. It's just people sort of quit. Who really knows why? But if the company sucks and the fundamentals keep getting worse, then if anything, you should be shorting more there. And I do that a fair bit because you don't want to let the position size slip to zero. Depends on the type of company. Some companies, it's more the crowded shorts, the story stocks, the ones that go on forever. Those are the
Yeah,
ones you can't really add on because those will have a sort of this weird, volatile, unpredictable trading range. But for a normal short that's just sort of boring and nothing's happening and it's trending down long term, there's lots of these companies, or a lot of my shorts, they're not even trending down exactly. They just sort of go nowhere, nothing happens. Um, yeah, and in that case, let's say your account's up 40% on the year or whatever, and then next year you realized, oh, that boring short that I shorted a year and a half ago. Now it's a really small position just because the account's growing. Maybe the short hasn't even won, but now as a percent of your NAV, the short has become this small position. So now you can just add there too. And then yeah, if you're losing on a short, it's great. You just take the tax loss, and then you can sort of set an alert for 31 days to wait for the wash sale timeline, and then you can reevaluate. And then like that's good for two reasons. So you got the tax benefit, one, but the other really big benefit there is when you've been out of the stock for 31 days and you come back, you're going to be so much more objective about like, did the fundamentals shift? And sometimes, it's easy to, like, if you don't quit, to sort of be stubborn and ignore the fact that the fundamentals are actually improving on this thing. But as soon as you quit and you don't have the connection to the stock anymore, and you've sort of not thought about it for a while, yeah, it makes all the difference. You're way more impartial and you'll make a better decision. And then other times, that's not the case. And it's just the price just even randomly wandered up. You can't even find news. Nobody's even talking about it. In that
Yeah.
case, you can just sort of rejoin for not, and you don't rejoin the full original size, by the way. So people have this really dumb tendency in short selling to want to break even on the short exactly.
Yeah.
But the market doesn't care. Okay. The market doesn't care what, you've already lost on the short. All that should matter is like, oh, okay, my risk size for this volatility and this type of stock is 0.5% or whatever. So that's how much I'm going to bet. It doesn't matter that I've like already lost 0.2% on the stock. And it doesn't matter that it's now going to be very hard to ever make a profit on this short. It doesn't matter at all. I shouldn't even think about that.
Yeah, so I mean, emotional detachment is really important, maybe the most important thing. I mean, some really smart
Yeah.
guys get destroyed by being too involved emotionally, and they are like, "Oh, I need to win because I'm used to winning, and I'm really smart, and I need to win again." So, I mean, that's a way to get destroyed, basically. And I mean, traditionally, long short hedge funds, they would buy undervalued companies and short the overvalued, and that worked till 2012, let's say. And I mean, or even till 2008. And after that, we see that they are not doing really well. And so, do you short? I mean, you said that you have baskets of different shorts, let's say with different logic, if I can say it like that,
Yep.
uh, behind why you're shorting them. And do you have like a basket of these companies are overvalued, but not like story companies that everyone knows about, different companies that you think they are like too expensive for what for expected growth or whatever? Do you short them, or are you simply shorting, I mean, mostly really bad companies or companies that you expect some kind of fundamental deterioration?
Yeah, I think I try not to, I never do it only on valuation, but in some cases, like the best example I can think of is that they're like, it's a manufacturer of commodity rubber hoses and like metal hoses. Um, and it's the most commodity, sort of low quality, crappy business you can think of. And then for some reason, I found this one that like somehow it had traded up to like 80 times earnings or
Is it
something.
in Canada?
No, I think it's US listed, but yeah, if you spot something like that, and those kind of stocks, obviously what happens is they trend up for a long time, and it doesn't really matter why it's trending up. If it's trending up, I don't think that's a good thing to fight. But if you can find a stock like that where you saw it trend up for a long time and then now it hasn't done anything for a year or two, so the trend is broken, for whatever weird market anomaly was causing that buying to happen sort of blindly or stupidly, or sometimes it's these really shady funds and they're
Yeah.
actually cornering the stock, and what they're doing is just jacking up their performance fee, man. And so that's a good one. So if you can find a fund that did that, you can actually see who owns these things, right? If they own a huge stake, or sometimes it'll be like, yeah, it's like an ETF. Some ETFs do that too. It's very shady, but they do it. Um, So yeah, if you spot that and you can see the trend is broken, then that can be a great short on valuation alone. Well, not
Uh,
alone, but you know what I mean. Like you don't need to actually overthink it. There, it's like okay, the thesis is as simple as some weird thing caused this thing to become really overvalued. Like you're saying, it's not a story. Stories are scary, right? But this isn't even a story. This is just some weird kind of
yeah,
nonsense.
manipulation.
And
Yeah.
then perfect. And then you can short it there. And then that's a good one.
And do you ever use technical analysis? I mean, do you look at the charts? I mean, because I mean, I want. Why I'm asking you this? Do you short companies that are like that have strong momentum, that are like in a strong uptrend?
Usually not. I mean, sometimes, but yeah, I tend to avoid them or like I'll put them on my watch list and then I'll sort of, you can sort of flick through your watch list to see what the stock is doing. I don't know if I'd call it technical analysis exactly because I'm not looking for like chart patterns really.
Yeah.
It's just as simple as like, is this thing still going up or not?
Okay. Yeah. I completely understand. I remember reading a book, interesting book. I don't remember the name. It's about trading. And a guy that wrote the book was like fundamental analysts. They ignore the fact that there's a lot of technical analysts and traders, and the traders can might be the reason why that company keeps going up. So I think that we should take into account existence of traders and of course quant funds and CTAs and stuff like that that are like basically doing momentum factor, and that's the reason why stock keeps going up for no other reason than that everyone's piling in.
Yeah. Did you see that post from Walter recently? I don't know if you follow him on Twitter. I think, is it Walt373? I think that's right.
I'm not sure.
Um, yeah, he had this really brilliant post. He said there's two types of trending stocks. There's one that keeps going up and people keep buying it because it's going up. So they're
Exactly. Yeah.
momentum chasers. But there's another type where people are buying it despite the fact that it's going up. And these are like very value conscious, fundamental, real investors. And they're
This is
buying it
actually very
anyway.
good.
They
Yeah.
don't care that they're buying it all time high. And if you can find those stocks, man, those are the ones. And I replied to that post and said, if you can buy nothing but those, you're going to kill the stock market.
Yeah.
But obviously, it's hard to find them. So
Yeah, and always there's, for example, is Palantir that stock? Trading at in crazy multiples, but you will
yeah,
find a lot of guys that are in the
yeah.
latter.
I think that's a great example where people are just buying the winner, or you can see a basket of stocks like that. You can just look at ARK, and that thing just goes on these crazy uptrends for quite a
Yeah.
while, and then it always breaks down because the thing is nonsense. Um, yeah, I don't really like to short that kind of stuff much because I don't know, that kind of thing is annoying because even if the trend breaks on a strong story or a cult, who's to say it won't just restart again in 2 months, even after it broke? That's why I hate these stories. And it took me a long time to stop getting involved. I wanted to, I thought this is really stupid and everything. But as soon as I stopped ever getting involved in those, man, it became so much less stressful. It's unbelievable.
Yeah, I understand, especially on the day that market went up more than 10% in a day. Yeah, I was net short, man. I was
Yeah.
I was outperforming market by almost 20% at the time. Maybe not 20, 17%. I mean, I was doing well, and I was net short that day. I had, for example, I think I had short Tesla. That was one of the larger ones, MicroStrategy, and
Yeah.
some high beta names. And luckily, I was able to exit relatively quickly. Pretty much, I closed all my shorts. I had like I don't have nearly as much positions as you do. I have usually about 30 positions. I closed all my shorts at the time, and I was down for the day like 3%. However,
Not that bad.
next day was 5% down. So I made money that day because I went again. And
Hmm.
do you ever do that? Do you ever like do something and then you realize that you probably made a mistake? I mean, that you probably made a mistake and that you should add more. That this is, too extreme in one way for one day. For I mean, that was
I'm
the
not.
bottom basically. But
I'm not that good at trading that kind of thing. I've I've sort of realized over the years I'm not good at that timing daily short-term trades. So now I actually just try not to even think about it mostly. There, sometimes you'll spot something, but
yeah, but I understand completely. But I mean, that's the way I try to utilize the small amount of capital. We spoke in the last episode that when you manage few millions, tens of millions, I mean, you can exit and go in relatively quickly. Unlike,
yeah, but the benefit of that being that small, right, is you don't have to do it on these high beta, super reactive names. Because if you're in a portfolio of like thinly traded, less liquid stuff, and especially as a really small player, man, like for all you know, on that same day, if you were involved in way smaller things, there's a good chance on half the things you could have quit for zero loss. I mean,
yeah,
they wouldn't even have moved. And then that's the whole damn edge. And that's extreme. You would have lost a couple percent instead of way more.
yeah, yeah.
So just that's why I think not getting involved in these liquid ones, and I'm bigger, there's almost like more justification that I should be playing that game now or whatever, but I'm just not going to. No thanks.
Yeah, I mean, I had to say it because you said that you needed a lot of time to completely ignore those companies. And for example, one of my best shorts are basically companies that have like really small short interest. For example, my
Yep.
best short was this year. I think this year my best short was EA Sports, and I mean, they even published bad earnings. They fell down even more. So also I shorted John Deere, and
Hmm.
I exited some smaller unknown companies. But do you short like really small companies with like?
Yeah. The thing is I always tried to start in the Russell 2000 companies. And actually the cutoff for that is it's crazy. It's like pretty low today. It's 130 million market cap. But when I first got involved in markets, it was closer to 150 million. So it's kind of interesting. It's actually gone down since 2018. Um, but yeah, I think that's a good market cap range to get involved in. It can get pretty volatile and crazy that low, of course, but as long as you're sizing it small, like if you have a 150 million market cap company and you're shorting it, you could just short like 0.3%, and then
Yeah,
rarely the thing will go up 300% on you, and that sucks. But you didn't even lose a percent there. It's not that bad. And usually that kind of move's not even correlated to anything because it's a low short interest, boring thing, and weird things happen. But it's not going to happen at the whole short book at once, which that's what matters is when they're all going wrong at once.
yeah, and I mean you made several really good points. Uh, but I
I
want
mean,
to.
I had to learn the lesson. I'm not kidding. I had to learn this lesson like 20 times. Every time I'd be like, I'm not doing that again. And I'd do it again. I'd be like, why the hell did I do that? And then,
Yeah, I'm definitely not doing it again because I was. I'm definitely not doing it because I was up on my shorts, like not close to 10%, I think, only on short positions, and then after that day, I was like 3 to 4% down, and so it basically cut in half for no apparent reason, and then on the in this market, I lost some more on the shorts, but I'm doing well luckily. But that required a lot of work. And I mean, how did you perform under this Trump market? I mean, because you are basically someone that's more short seller than long uh, investor.
yeah, well, I mean, I did like quite well through it. So um, yeah, it's actually pretty lame. The compliance people have been yelling at me about what I can and can't say. So I guess I'm not allowed to talk about exact performance numbers, but uh, yeah, I did
It's
well through it. And then um, yeah, I hate that about compliance, man. Um, but yeah, basically, I posted on Twitter before the whole thing happened that, I thought Trump would surprise to the upside on tariffs. I made a post about that, and I bet accordingly. And then after the volatile move, uh, you know, I, you know, that was the bet. So I sort of took the extra bet off. So the whole thing went really well for me.
So you basically told us in last conversation in the previous podcast that inspiration for your strategy was a paper named "Betting Against the Beta," and
Mm-hmm.
it's something you base your strategy on. And the betting against beta in that paper, it's basically the logic of the paper is doing a research on the which factors, which companies outperformed, did well, and which didn't. And in modern portfolio theory, higher beta basically tells us that we should expect higher return. And they proved us in a paper that actually lower beta companies did better, especially on risk-adjusted basis. So you base your in investment philosophy on that paper, if I'm not mistaken, and how you evolved, let's say, through time. You were probably buying low beta, shorting high beta, but I mean, shorting high beta is dangerous in itself.
Mm-hmm. Yeah, I don't that you can't do that mismatch alone. It's not that simple, which isn't surprising, I guess, because even just the quant people could do that, right? So they've already figured out that basic strategy. And then if you do that, just having that factor mismatch, you just get slaughtered
Yeah,
sometimes when both sides are going against you at the same time. There's a feedback loop. So you can't get stuck in that feedback loop. You want to position your portfolio in a way where, you know, you're doing well even if other guys have to degross. You at least want to be only losing like a little bit. And you do that by like the best way by far we've talked about a bunch is avoiding the crowded shorts, but even just not shorting only high beta things. So you want like if you can find like a lowish to medium beta, lowish to medium volatile company that kind of sucks, that's actually like a really underrated short. Um, and then there's so many like that. It's hard to conceive of them ever becoming crowded as a group. I mean, at that point, you're just in the pure like fundamental investing, which is where you want to be, because that means your portfolio will actually win with the fundamentals long term, rather than just being a slave to the factors.
yeah. Rather than being slave to the factors. I mean, that's a really good sentence, and it pretty much explains the world we live right now. I mean,
And
everything.
it's not going to change, by the way. Like this isn't. Some people think the current market environment's like really crazy and irrational, right? But when you think of it, like as betting against beta, it can't be some free lunch, right? It
Yeah,
can't just be like everyone puts in $100 billion into this and just prints their way to 20% a year, because obviously after a very short while they'd have so much money in the strategy and it doesn't work. So in some ways, I think the market's really efficient. So, a guy like Jim Chanos, he had a pretty easy time of short selling actually,
yeah,
because back in the day, the factors didn't, these sort of anomalies didn't just get taken out by the quants yet. And that's why he's struggled so much, is he's not adjusting. He thinks he can just be in mostly the higher beta, super crappy, obvious thing. And that's actually not even a strategy anymore that can work.
yeah. And I completely agree with you, and that's why I said that. I mean, golden age for hedge funds was, I mean, basically from the creation of hedge funds, from the first hedge fund through the 70s, 80s, 90s, 2000s, they did really well. And then after that, after GFC, it's completely different game. I mean, and it's not as easy as it was. And I mean, from this perspective, I mean, you could have a guy managing hundreds of millions or even billions that basically buys undervalued and shorts overvalued, and he would do only that. And of
Hmm.
course, there were like periods like 98, 99, 2000s when short sellers were getting burned, but pretty much, I mean, they were doing really well. When we look at the hedge fund index, it outperformed for that period. And uh, what's your opinion on profiling, if that word exists, yourself for like I'm a value investor, I'm a growth investor, I'm this, I'm that. What's your view on I mean, being putting yourself in some kind of a group? Because I mean, that loses flexibility first of all.
Hmm. It just shows like a fundamental misunderstanding of to me of what you're even betting on. There's some really smart guys out there. I know one guy and he only buys quality stocks long. He's a
Yeah,
he's a pretty talented investor in a lot of ways, but you know, the entire quality factor as a whole got
yeah,
bid to such an extent that
yeah,
now his hunting ground is just crap. And he
yeah.
just stuck with it. He's like, well, it might be
Everyone
10
has the
times
same
revenue and
solution.
it's not even growing that fast, but I mean, I don't know what else to do because this is the only thing I do. And you need to be aware. And if we're playing a market here, we're playing a market of stocks. So if the thing that you're into most gets bid up a lot, and this could be oil stocks too, it could be some guy who's an industry only. You see some of these permeable energy investors too. It's the same thing where if you're only a one trick pony and you're playing the market and your thing gets bid up too high, you've sort of left yourself with no room to go do the correct big edge move. And but what you actually want to be doing is being as flexible as you possibly can. You want to say, okay, even if you're like a guy who's got sort of that value bias, it's almost like in your DNA, right? You sort of want to buy the really cheap thing, but it's sometimes you can sort of look at the market and say, wow, these really high quality companies are trading for like very like mid-teens multiples and they're growing well. Sometimes the market's like that and it's like, damn, those are really good buys right there. And then other times, the value stocks, I'd say the value stocks even today seem kind of overvalued to me, despite all the people complaining about it. But
Especially mid caps. I mean,
yeah,
that
and
factor.
just
I mean, those they were really popular because of the paper. That
mhm,
made them really popular because it showed us that mid cap value stocks outperformed pretty much everything, and then it
they
got
got too crowded.
yeah,
And then value stocks are really, really sensitive to valuation because it makes all the difference if the thing is, you know, doing a shareholder return every year of 8% a year versus say 4%. Man, that's like an enormous difference. If you have a stock which is spitting out 8% shareholder return, and it's not just like a total value trap like the current ones are, but like something that's genuinely paying that and it's, you know, got decent amount of bias to the upside even from there, that becomes incredibly hard to lose money on. And then if you have a bet that's got incredibly hard to lose money on, that's already a good setup. But at the 4% dividend yield, and then I swear the quality is like lower than before too. Now it's totally different, but people got stubborn. They want to play value stocks and people still quote Benjamin Graham and everything too much
that was
still.
my thought
Although
right.
that sort of died down some.
Yeah, and I mean Benjamin Graham, and I mean Even Buffett, how he made his money, I mean, he wouldn't be able to do it right now. So we should
Yeah.
try new ways. We cannot copy others. I mean, this is completely different game, and it's getting more and more about quants, which I, in some way, like because they make the market more efficient. But in the other way, I don't like because most of them are there just for the money. They don't care about the markets, about companies, about analyzing businesses. They're like, you know, purely for money, most of them, which I of course understand as well. But that I mean, you love this game, I love this game, and you enjoy it, and you know, I hope you get what I'm trying to say.
Yeah, I know from what they're doing is just a grind. And then
Basically grind, man.
people are doing a grind. I know how that works out long term. None of them end up liking the job and everything. So
Yeah,
yeah, and they're not connecting it to anything real. Whereas, with
exactly.
what I'm doing, since it's based on fundamentals, this isn't even like a moral thing, but at some point I can actually go make investments, not just in the stock market, but I can use the skills I've learned and make good investments to make money in a way less competitive market that way. Versus I think the quant game is just a race to zero. It's going to get more and more competitive, just like poker did. It's going to get more solved. Edges are going to go down. Frustration is going to go up. It's going to become even more of a grind. Um, so I actually don't envy the quants very much.
It's actually first time I heard someone with your perspective, and I actually I can say that I agree with you, man. And I mean, I did a lot of quant analysis myself, and I mean, I saw what they are doing. Of course, not the Rentec and that level guys, but it's basically pure math and physics. So, but on the other hand, as you said, it's you can use it in life, and I mean, I don't see them outperforming the market by the wide margin on regular basis. They have mostly they have good sharp ratios, but at the end of the day, they pay discretionary traders hundreds of millions to trade whatever. I mean, I from gas to whatever. So special skills, and the guys that are like really good at that discretionary side, they're they are the ones that get the largest amounts of money. If
Mm.
we exclude the rent tech, probably I think they manage only their own money right now, if I'm not mistaken. So, but
Yeah, and
they
there I think there are a few like lower key ones than Rentec, but I think that most of it, or they're really, really small scale. I know one guy who's doing quant stuff and he's got like a 12 sharp ratio, which is kind of cool. I mean, that thing's just a straight line up, but you can only manage a few $100,000 with that. So, it's not the same and it's very grindy. And who's to say when that edge disappears or not? And yeah, that's not the kind of game. I think AI is going to solve most of those games soon too.
exactly, man. So at the end of the day, if you look into the future, I think the only way you could actually outperform the market would be to exploit the psychology, because we'll always have market participants. Of course, now we have much less than we did 20 years ago. I mean, when you go to the floor, you see much less people than there were like 20 years ago. But still, we'll have market participants and we'll have decision makers. I don't think that we are going like 100% computers trading against each other.
No,
I mean,
I
we'll
don't
have
think
to
so.
have decision makers, and at the end of the day, computers cannot understand human mind because we don't understand it, and it's I mean, computers are rational and humans are irrational. So how can you understand irrationality? So I think at the end of the day, there's always going to be a way to exploit human irrationality, which is really hard, of course. I mean, it's really, really hard. And and I come back to the Soros and the general theory of reflexivity, where he basically explains pretty much how expectations work. And not only him, a lot of guys talk about it, but it's like Howard Marks, for example, but it's really hard to do it in practice. But that's something that's going to stay. And regarding that, how do you detach from the market?
Well, I just try not to get, like, I don't really try to focus on the general market almost at all unless I have like a catalyst. So unless I, spot something like a escalating trade war or something, then I just try not to even think about it in terms of the market. I don't even really care too much. I run with a bit negative beta, so if the market's skyrocketing, I sort of have to care a little bit, but it's not so negative and it's pretty much fine. So, and then for the individual positions, I just try not to get any kind of attachment, especially on shorts. And then, but on longs, usually there's a few that you know a bit more about and you're a bit more close to. Maybe those ones you have a bit of an attachment, but it's not, usually those are kind of boring and nothing's really happening anyway. Good companies kind of that way. And then the rest of the positions are so small, especially like these Japanese small cap bets I have. I don't even really think too much. And if the results start turning the bad way, I just sort of quit. I don't even think about it, you know?
Yeah, but did you have like bad quarter of trading where you did? I mean, at the time, were you like, this is just numbers, or like this is going to pass? I mean,
No, I think when I lose, I don't take it very well. So, like the worst quarter I've had so far was the quarter two of 2023. That was when the AI hype hit, and I was totally offsides on that. Um, so in that instance, that really sucked. But then, I got blindsided by really a humongous variable, right? Because that's sort of like a dot com level regime shift in the market. So with that, that was particularly extreme. They don't happen that often like that. I'm not even going to get blindsided every time on them or anything. So if you back those out, nothing's too volatile. Nothing's really happening. Um, there's like these periods of like autocorrelation in markets. So all the high alpha people I know long term, they tend to all do poorly at the same time, even if their strategies are like wildly different. Um, it's not like some of them can still be winning and generating some alpha and everything, but the overall alpha that the basket of people is generating is way down, which doesn't really make any sense until you realize there are just times in markets where um, it's sort of the gambling market spirits are in control. And then there
yeah,
are other times when the fundamentals are in control. And these just happen in streaks, which makes sense, because once you realize that fundamentals are in control, it can sort of just keep happening. It keeps working. People like playing it. And then once it stops working for a while, people get bored. They move on. They start doing stupid things, making mistakes. So all I'm trying to do is hold on and sort of ignore everything. Um, like one of my business partners thinks that I should be trying to focus a bit more on auto correlations, so that like I should decrease my gross leverage when the auto correlation is against me and increase it when it's in my favor. But just with tax reasons alone, that's really tough. Now you have to like realize a ton of gains to hope that you can time this auto correlation right. So instead of trying to do it that way, now I just try to make sure that the whole portfolio is set up so that if the market's being crazy, that I won't lose. So actually today I was actually contemplating very seriously, like I was comparing my historic results. And if I just took my overall results and I added some like long I wouldn't buy ARK itself, but if you just bought a basket of the ARK stocks and you just bought like 20% long that junk, then actually my results would have stabilized, and it would be like the chart would just be way more of a less volatility. And this would have been what, a minor performance drag since inception. I would have lost like total like 4 or 5%. But think of how much brain damage that would have saved me. So,
Yeah.
and I'm thinking pretty seriously about this. I'm looking at them like, well, these are the story stocks. These are the ones people buy because the quant people just know you can buy ARK to buy the story stocks. So you can pretty low IQ just buy those ones to accomplish this. And I'm looking at them pretty serious. I'm like, why don't I just buy 20% of this junk?
I'm laughing, man, because at the end of the day, to stabilize your portfolio, you need to buy junk.
Yeah, for sure.
That's the market we are in, you know?
Yeah, but it's just the case since I've been investing. This is I started in 2018, so this is the only market I've ever known. And like older guys keep talking like this has to go back to some kind of normal,
Yeah,
but
not
I
going
don't
back.
see why it does. In
No,
fact, in some ways, I'll even say to them, I don't see how it can return back to this supposed normal. The market
no
is
way.
too solved now. And what you're hoping is going to come back is like essentially a free lunch, super simple factor bet. And so, yeah, I mean, and I was already thinking of doing it. I think I might just do this by the 20% long ARK bet. And it's ridiculous, but when you say it that way, it makes sense. You're combating all these people who think that the market's going to, revert back to some normal state, supposedly normal state. Uh,
I don't see it happening, man. Especially, I mean,
so,
when I look at my generation, Gen Z, basically, everyone is about zero commission brokers. Everyone wants to buy those high beta names, those story names,
yep.
and ARC is full of those companies. So what's going to happen is that ARC is probably going to go up a lot, and then it's going to crash a lot for 70-80%, and on repeat, basically. Then we'll have another arc, and then that's going to happen over and over and over again. But as we see in the market right now, everything's going to be more extreme. Correction
Yeah.
is more extreme, and the recovery is faster. I mean, I even debated one guy on X, and he was like, "No, we are not going to have a V-shaped recovery because market lost trust." And I'm like, man,
Yeah.
when Trump changes his stance, everyone is going back in. Shorts will need to cover. Retail is going to be, geniuses because they bought the dip.
Hmm.
And
Pretty much.
that's pretty much it, man. Uh, okay, David.
At that point you made too about the zero commissions, I think that's a big important difference compared to the past, that the
Yeah,
older generation also doesn't fully appreciate what that means. I mean, your counterparty used to have this average holding period of a stock. I mean, it's gone down over the years, but before it was still reasonably low. And then these guys are paying some fat commissions on their small accounts. And just the commissions alone will get their account to zero. And then on the broker now, they're the ones who walk away with all the money. And there's a big liquidity sink that doesn't exist anymore. And this is never going to go back. And if anything, you know how Robin gets paid for their payment for order flow? They're actually like,
how they get paid?
yeah, like they're getting paid for the payment for order flow, right?
Yeah, I know that. Yeah.
So that means that what Robinhood is doing these sort of loss leading strategies just to get more of that. So actually people are essentially now, they're not just not paying a commission, they're actually getting paid to go gamble it up. They're actually being given more free money than zero. Now they're the credit card that gives them 3% cash back, or they've got Um, Margin interest rates on Robinhood now are even cheaper than interactive brokers. Uh, they've got um, what else? Like they do the retirement account matching and things like this. They just give you 3% of your money for free because they know that enough of their customers are just going to spew off the money to these higher frequency guys. But but yeah, this that's just a hell of a headwind to fight compared to the past, and it's never reversing.
And I completely agree with you. We actually bought Robinhood at 11, so
Nice.
it's probably our most profitable position, and
That's a good investment.
We are
Yeah,
not
that's I
selling.
think that's their business plan's really good.
Yeah, and what's I mean, their business plan is for basically for young generation. We are onboarding 18 year olds, 19, 20 year olds, and gamification and dumbing it down, making it even more simple, something that in itself is really complex and dangerous. And they made it like really simple and really easy to use. And everything you said is, I mean, cashbacks and stuff like that. I mean, it's completely crazy, and I don't see them like we will have corrections, large ones for sure, but especially in kinds of names like Robinhood. But I do think they have the bright future. Uh, what's your view on Louis Vuitton? I have
I'm
to ask.
still long the stock. I think it's a good stock. Um, every time I drive by Louis Vuitton, there's a long line. Um, I don't even like luxury brand stuff really, but actually I go there and a lot of the stuff seems genuinely high quality. And for the price you're paying, it doesn't even seem that crazy. I mean, some of it's kind of scammy, but some of it's like pretty awesome. It's like that's actually pretty cool. And yeah, so I think they probably are a lasting brand. I mean, the brand has been around for a really long time.
Yeah,
I I think it's just going to be more popular over the years. Part of my thesis with it is that we're entering a world that doesn't have real scarcity anymore, and so you have sort of an artificial scarcity. People have an innate need to get that limited edition thing or whatever. They need to feel like they have the special, unique thing, and Louis Vuitton, accomplishes that pretty well. Especially in America, as an American, I can see it really clearly because a lot of my American friends. So my the generations in America that get ever increasing bigger houses. But actually, once you get to a big enough house, and we have even smaller families now, it just becomes absurd. It's like, what the hell does the bigger, even bigger house do for me? It's just there's nothing nice about it. It's just actually a headache at that point.
yeah,
And I swear Americans have already reached that point where they don't even need a bigger house at all, or they've already overdone it. They already all have like a new car, and there's nothing special about that. And um, so, yeah, I think Louis Vuitton fills in a void there once the country gets rich enough. And I mean, there's the bearish argument on AI that it's going to ruin everything, but I think more likely it'll end up being good for the economy and everything. Productivity will go up, things will get less scarce, and but then what are people even going to buy anymore? Louis Vuitton.
I agree with you, and I think that I mean when we look from for example, Wolf in Kashmir, as they call Bernard Arnault, uh, he said multiple times that he basically doesn't care about short to mid term. He only cares about long term. And I mean,
Mm-hmm.
in itself, it's a family business that it's public, but he basically controls the company, and he has two or three of his children in the company. His son is doing really well with watches. For example, having a luxury brand make a watch was a joke up until recently, and I see a lot of watch critics saying positive stuff about Louis Vuitton when it comes to watches, which is something that's interesting, and it's basically new generation of his family doing that stuff. And That's a different thing about Europeans because we have a lot of family-run businesses and they can actually plan for the long run, unlike
Mm-hmm.
most of American companies that basically do it quarter by quarter. And I mean, it's everything about guidance. And while in for example, we had a situation with Swatch where owner of the company was like, I don't care about the quarterly results or whatever, and company was going down and down and down, and I start following it a few months ago because I don't have I cannot follow thousand companies. How do you manage to follow, man? You said that you have AI do like the most important news that you read every day, but it's like 200, 300 companies. How do you manage to go through them?
Well, the AI thing's just for the Japanese companies.
Just for the Japanese.
Yeah. For most of my longs, I don't even like read the earnings reports or anything. So, for example, um, the airports or the natural gas pipelines, or like Amazon or even Hikari Sushin, um, Unext. I don't need to really. Unext, I follow that one a bit more, but the earnings don't really mean anything for any of those companies. I don't know why people even get caught up in that. It's like you're saying, where the American companies are super focused on the next quarter. I don't really care. Uh, I'm pretty sure that the airport traffic will keep going up. That's the whole thesis.
Yeah.
So, now my time invested per year on that, I open the financials twice a year, and it takes me for the all of the airport companies a few minutes total for the whole year, and that's a few of my positions. I don't even bother looking at the Amazon earnings really, maybe once a year. Um, Hikari Sushin is, very lumpy earnings because they have that stock portfolio, and that's really the bulk of the business. So in that instance, like looking at the earnings report, even over a year, probably doesn't mean anything at all. So let's say that the stock portfolio has a bad 9 months or something from here. I don't even think that means anything at all. So if I think that now, then what's the point of even following it? Um, I guess the thing is, my longs, I swear, nothing crazy pretty much ever happens. So it's not like these things gap down 25% in a day.
Yeah.
That doesn't happen. So if it did happen, then I would be really on alert, and I'd be like, what the hell's happening? The market's saying something here. I mean, that happened once with the Mexican airports, I guess. The market freaked out because twice, over one time an election result, and one time over like the government gave them free money during COVID, and then they just reversed that free money policy, and the market misinterpreted that as them like screwing over the airport. But it was like, no, they just ended the COVID subsidy, which is totally makes sense. That wasn't even any news at all. So that was a cool one because I got to buy it. But but the vast majority of the time, nothing's happening for any of my longs. Um, and then shorts are like the crazier side because um, things happen. You have 200 shorts on, and usually you have like a fire to put out, at least a couple per week. So in that instance, each time that's where more of my energy goes. But rather than try to like follow all 200 and see like what's happening with all of them all the time, I've more like got my simple thesis. I've already pre-selected them to be less risky so that there's not too many things going wrong at once. And then when the fire's happening, I go in and see what's happening. And usually it's as simple as, oh, okay, the short's losing. I can harvest a tax loss. Let's just harvest the tax loss. And then you set an alert for 30 days out for the wash sale. And then that's it. And then you in 30 days you reevaluate the situation. And so the whole tempo of everything I just gave you there, basically the maintenance on the longs is almost nothing. And then on the shorts, we're talking about not that much effort. It usually, to figure out a fire on a short, you're thinking about it like an hour or so. So let's say you got a couple of those a week, so you're spending a few hours a week on that maybe in a bad week. And then like the rest of your time is freed up to just sort of look for better ideas. Or and then another thing I'll do is a few times, really it's twice a year, I'll go through and one by one every single position and just try to make sure nothing's stale or my idea of a thing didn't change. I try to think of how my worldview has shifted and does that thesis still make sense. Um, but usually the shorts are so like on the longs, I swear it almost never changes anymore. It took me a long time to accumulate so many longs like that. Um, but now that I have them, I sort of have the longs that make sense to me, and they seem to do okay overall. So, but on the shorts, it's more dynamic. So you're sort of going through a couple times a year. That's a pretty time consuming process, right? You're going one by one through 200 companies, and you're giving it a real serious consideration. So in that instance, it'll take you like a few weeks to get through this. You're doing that a couple times a year, and that's a pretty intensive review process.
But basically, so you play on the huge trends on your longs, and you use your shorts to basically not lose money on your longs. And what you actually manage most of the time is your shorts.
Yeah, and my edge is bigger on short selling.
Yeah,
So my alpha on that side is way higher than longs. Um, but I'm still generating some alpha on the longs too. So
yeah, yeah. And I'll ask you, okay, one more question. What's your view on do you invest in China, in India,
no,
and
no, I don't think China's good to invest in.
do you short China?
I don't, especially the individual stocks, no, because they're really manipulated. That's I think if you want to blow up as a short seller, just go short some Chinese stocks. I'd say that's probably the very easiest way to blow up as a short seller. So I don't think anything about China is real. Like it's not all as it seems. You don't own what you think you own. Um, I mean, that economy has done like how they've developed over the last 30 years is just a miracle, right?
Yeah,
And yet somehow their stocks have this crappy return.
yeah,
So does that, you sort of zoom out and you sort of ask the big picture question there of like, so you had a miracle outcome for the economy and you got a crappy return. So like, what are you know what I mean? You zoom out and that tells you the answer. Um, and then like you can pick a few things. You can say, well, Tencent was the one. You know, maybe that'll keep winning from here. I don't know, or maybe even that one will end up being a poor investment. And there's I think a couple like that, but for the most part, I've looked through so many Chinese stocks, and you know, it just seems like I guess the really high dividend ones are kind of interesting
yeah,
because you know some of them are paying 12% dividends, and
yeah,
the dividend is actually increasing and everything. So if I was going to play China, I'd be focused on those. But they're also just not that liquid. It's just not. Yeah, I don't know. It's just not really. I guess I look at the overall basket too much and say screw this game.
yeah. I completely agree with you. I usually what I do is that I basically place a swing trade on China from time to time. For example, when we had those this large move up, I bought before that. It was some part in some part it was a luck. In other part it was um, I had the feeling, and then I
Mm-hmm.
started doing some digging and expected China to do a stimulus. and to be a large one. And basically, I bought for that reason. When it went up, I sold. And
Mm-hmm.
so I'm not a huge fan. I mean, as you said, just look at the long-term chart. I mean, it tells you everything. And I mean, they're basically a buyers of real estate, gold, and cryptocurrencies. I mean, if you
Yeah.
trust your government when it comes to stocks, why am I going to do the same? I mean, a lot of I think the name of the company is Ehang or something like that. They were like
Yeah, the
basically,
EV,
yeah,
the helicopter
flying
company.
taxis, flying taxis.
Yeah.
They basically created multiple companies that were like buying from each other and financial engineering at its finest. And we have a lot of that, especially in companies that are uh, like having 100% operations in China. But do you invest in India, and do you play like I invest in those markets by, for example, I was buying a C. I bought them. It's one of my best buys. I bought them at like 36, 37. You know the C company. They have Shopee. They have C Money. They have Garena. For example, they are in the time of the post-COVID hype. They went. I think their CEO was like, "We are going to be a trillion company." They went up. They were one of the best performing stocks in 2020, 2021, and then they crashed really hard. But they have a good story. They fundamentally, I think they have a great perspective because they are doing a lot of work in markets like Southeast Asia, and I mean from
Yeah,
the
Shopee was big in Thailand when I lived there.
yeah, they own Shopee, and they are in Indonesia as well. But on the other side, I like, for example, Mercado Libre. You know Mercado Libre for sure. Uh, and do you play like you said you invest in US, of course. You mentioned Mexico. You mentioned, of course, Japan. But do you like invest in other parts of the world? We said we talked about China.
I I've been involved in like one Indian stock, the Make My Trip. Oh, also the FIH, the Fairfax India. I've been in that one. I think that one's maybe good, but also the fees that he charges is kind of high. And the AUM's kind of big, so maybe that's kind of tough. Um, but yeah, the Make My Trip was a good one, but I'm
Yeah,
not in that anymore. It went up
yeah,
too much.
yeah. They went up
Um,
really much.
and then yeah, India, the market seems very the high valuations, and then I can't even buy most of the stocks unless I go through a whole process of setting it all up. So I'm sort of given the valuations, I'm not too keen on setting that all up. Um, but I mean, I'm invested in. I've got a Swiss railroad, couple of Swiss railroad companies. I'm long like Wise, which is listed in London.
Yeah, it's London.
I've
Yeah.
got I've got the Spanish airports. I've got Louis Vuitton. Um, yeah, so I'm pretty much all around the world. I don't even know if I have a Canadian company anymore. Maybe not. I used to like that Linamar, their car parts company, but now I'm really bearish on cars. So I don't have any. I have one Korean stock, that Gravity, the video game company. That's like a net, but it's also really poorly run. So, but I like that the correlations like low to everything. So that's kind of
Yeah,
cool.
yeah,
Um, I don't have any Australian stocks right now. I had that Serve Corp, but it was just too illiquid for me to play it anymore. You know, people on Twitter talk about that Regis company, um, but this is like the Australian version of that, and it just seems much better run. It actually pays a dividend, and the dividend's growing, and the yield's high, and the business makes sense to me versus the IWC, I think IWG, International Workplace Group or whatever. That's the London one. I don't like that stock because I saw that they weren't even improving the company after a couple of years, and they were not doing what they said they were going to do, and the experience is really bad. So the bulls aren't actually looking at the product there. I think when they actually use it, I used the product and I said this is no good. Um, that's what other countries? Yeah, I used to be more involved in Polish stocks, but they're so illiquid, so
Yeah.
it's pretty tough. Um, yeah, what else? I think the country I'm like really bullish on today is Mexico and Japan. Those two seem, I like Colombia too. I mentioned that last interview.
Yeah.
I like those three countries a lot. I mean, you can see it in my positioning. I've got heavy exposure to all three of those.
And I'll have to ask you one more question. What's your macro view? I mean, if you have one, we spoke last time that uh, I mean, as you said in this interview, you position yourself so you can survive pretty much anything. Especially if it's something bad, you're going to do actually really well. So
Mm-hmm.
only way for you to actually lose money is in a highly speculative and bullish market. But
Yep.
we had a lot of talks about fiscal deficits, bonds, 30-year at 5%, and so on and so on, and that we are never going down when it comes to interest rates. Do you have any opinion of that? I'm asking you because, like, everyone and my grandmother is short bonds right now and short dollar. So that is
I've
crowded
noticed
as
that
well.
too.
What?
I've noticed the crowding on the dollar short,
And bonds,
and
man.
it seems like everybody is in that. Yeah, I mean, I guess I'm sort of guilty of it too because I'm short these like private equity bonds, but that's a lot different trade too. I mean, that's sort of for a different reason, but so I've unintentionally, I guess, joined this short the dollar brigade. Um, yeah, I mean, at least short term, that trade seems really, really crowded. I don't even know why people are so bearish on the American dollar because, I mean, at the end of the day, American exceptionalism is still pretty much the truth. Uh, at least, I mean, in the West, are hardworking, super motivated people going to move to Europe that often
No,
or European? No, they're going to move to America.
exactly.
And and then if you zoom out and look at the globe, and you see that where America's positioned, that people keep like we talked about the sort of dangerous warlike world from our last interview, but that's that's not actually America's problem. When we look at the globe, you zoom out and say, okay, America has these huge oceans. We're independent on every kind of input we need. We now have the Taiwan Semiconductor setting up shop in Texas. They have infinite power there with our gas. We have a great partners in Mexico to get reasonably cheap labor. Um, there's no physical, besides like nuclear weapons, I guess, there's no actual threat at all to America. It's just not our problem.
And it has a healthy demographics. I mean, you have every year constantly new people coming into your nation, unlike
Mm-hmm.
China problem, Europe problem, Japan problem. Okay, India has a really young population. Africa has a really young population, I, but America has constant inflow of new people and
And they're
much
great
better.
people too. Like
Yeah,
when you meet the immigrants who work at like these random jobs and things, they're like these super motivated,
yeah.
hardworking, patriotic people. They're happy and glad to be there. Um, they're trying to improve their life immensely. Um, Yeah, I mean, there's sort of this pessimistic part of America, but that definitely doesn't, that's not the whole range of people in America. And I don't understand where, yeah, I don't know where the American pessimism came from. I think people are just pissed off at Trump still, but fundamentals win. So,
I completely agree with you, and I ask you this because I myself was really bearish on dollar when we compare it to euro, especially at the beginning of the year, for multiple reasons. But one of them is definitely that if Trump wants to achieve anything with manufacturing, he needs lower dollar. I mean, he
mm-hmm.
cannot do it with basically it's 4% difference to euro and to other baskets of currencies. I mean, dollar in itself, because it's a reserve currency, is really strong and let's say expensive. So only from that perspective, I understood it. But now I'm longing bonds, and I even have some leverage. And because everyone is really bearish on them, and and they make some points that it's like we are never going to lower rates or whatever. And now we had this CPI, we had previous one. Everyone said that we will have in this CPI inflation, you know. And now everyone says that in next CPI we'll have inflation, then in next and in next and in next. So I don't think it's that simple. And who knows? Maybe even Trump may, makes a deal and we don't have any kind of tariffs. So uh,
Mm-hmm.
I see a symmetric bet on that level simply. And of course, if something goes really bad, bonds are going up. So it's also a way to hedge, and also correlation with the stock market. So I'm building a position over there. So I just wanted to to hear. I mean, it's a contrarian play right now, especially because
Mm-hmm.
everyone is bearish on bonds. But let's see how that plays out.
Yeah, so I think like there's sort of two components of it. There's the short-term crowding trade, which I like that side way more. And then there's sort of the macroeconomic long-term view, which is that stuff is so hard. Because yeah, you have American exceptionalism and reasons to be bullish long term, the way I explained, and you pointed out the demographics. But then, like, a counter argument is that our deficits are really, really, really bad. I mean, we're in like a 7% a year deficit here.
Yeah,
But then, like, I'll talk to some friends, and man, and they'll just so casually say just a good, very strong counter argument to that. They're like, "Oh yeah, but all they have to do is like raise the Social Security age some, and they're totally right. Like, you can just solve the the budget problem hugely just by some small modification that way, or like I think the really bullish outcome for the U.S. dollar from here is if they fix the healthcare spending, because that's really the thing that's bankrupting, not bankrupting, but putting fiscal deficit so bad is just the that crazy amount we're spending on healthcare compared to anyone else in the world. And we don't really get anything to show for it either. I mean, these guys like
yeah, it's horrible.
play mental gymnastics with the numbers 17 different ways, but at the end of the day, we're spending over double per capita, and that's for as a percent of our GDP, we're paying over double, and we're already way richer too. So we're paying like triple the price for healthcare, and we're living way shorter than other people.
Yeah,
And even if you adjust for fentanyl and car deaths and a few other things, it just doesn't explain the difference at all. And so people play crazy mental gymnastics on that, and so they don't want to change it. But if the thing is, anyway, if the U.S. fixes this one key issue, and it seems like a really core issue that's sort of the elephant in the room in American politics, it's on a lot of people's minds, even if people aren't saying it. And you fix that, man, and the entire budget balances really well, really fast. So that's a Super Bowl outcome that's possible.
yeah, but I don't see that happening for a simple fact that there's a lot of middlemen, healthcare companies that earn a lot of money from that, and
Yep.
I think that they have a strong lobby.
Yeah.
And to me, it looks like they bought a lot of politicians, and that's
Mhm.
why this prevails, even though it
Yeah.
doesn't make any sense.
But that's basically what Trump is, because Trump is a rejection of the old political parties, essentially. Because what the people realized is that the old, like neither of the old political parties was actually representing the American voter. And so Trump's only the president, and he doesn't have the power to change it himself. But if it's possible that these other people who actually care about the American voter, if they can start winning more power, and if Trump was able to do it, why can't they? I mean, it seems at least possible to me. I agree it's unlikely, but it's possible.
For me, the easiest, I mean, the easiest, it's not always not the easiest, but the clearest path to lower deficit is simply to lower rates. And because it's
Yeah, that
1.3 trillion of deficit is due to that. Also, next year they'll have to refinance like 8 trillion of that. So that's why one of the reasons why I bought bonds, because I they'll maybe they don't do it, but I think that they really need to do something about it.
I think that's a really strong point. Yeah, it's also
And
real simple, which I like. So,
and compared to military and healthcare, compared to that, that's low hanging fruit in some way. I mean,
yeah,
compared to those two. So if they have, and next year is the midterms. So on the other hand, it's complicated because how can you do that? You need to abolish your tariff policy, which obviously right now you are still not willing to do it. I mean, so it's really complicated position, and but I mean, at the end of the day, we always need to bet on something. I bet like 20% or 20% ish or even lower of my portfolio, so I'm fine with that.
mhm. I think it. I keep thinking to get long. I don't. I just can't decide. Also, I'm sort of in a lucky spot where I don't even need like the catastrophe hedge. So I sort of lose that whole value of the bet. And then at the end, I do the thing again. I like to sort of zoom out on my bets and say, what the hell am I even really buying here? So in the sort of good case scenario, maybe I'm winning a few percent a year on this thing. I was like, a few percent a year is pretty lousy. So you know what I mean? But if you're right on the bond move, if you catch that move up to rates going to say 3.54%, then yeah, you make a huge one-time gain. But
Yeah,
then also maybe the psychology has permanently changed now after we had the inflation after so
that's
long.
my worry. Yeah,
Who the hell wants to own a bond for 3.5%
yeah,
anymore? I mean, that's just what kind of risk reward is that? The Fed could force it, of course. So that's the catastrophe outcome, which is that's always good for the holder. But besides that, I certainly wouldn't even consider owning the bond there. But I'm essentially hoping some other sucker will buy it for me if I buy it today. You know what I mean? So that's yeah.
yeah. That's why I added some leverage, because if it goes to, let's say, 3.5, it's going to, I mean, huge return if you have some leverage. And
Mm-hmm.
I mean, I don't plan to hold it for a long time. It's a midterm basically view, and I'm pushing myself more into the bonds because I don't have the experience in bonds. I'm basically 100% stocks guy.
Mm-hmm.
So either way, I will earn or I will learn. So
Yeah,
yeah,
that's a good way of doing it too early on. I think so. Not boxing yourself into one style and trying things and seeing what
yeah.
works.
I'm trying
Good.
to do as much as possible. I mean, as you said, and we talked about it multiple times. That flexibility is really important. I mean, who knows? Maybe maybe bonds will be hot in 2 years. I mean, I was shorting
Mm.
also bonds, but now I'm longing. who knows what I will do in the 2 weeks,
Hmm.
and
Yeah, because people have these weird, like, you should stay in your lane or you should know what you're doing or whatever. You should have your thing, but I don't really see it that way. I just listen to some of the best investors, and Druck, he says, it's better if you play all games and you can go play the easiest game. The only way you can
exactly,
do that
man.
is by
I
playing
mean,
different games.
exactly, and you can invest in pretty much any market. You can do. I buy crypto from time to time and I did really well on crypto, for example. So I don't like that rigidity, and you should definitely. Yeah, I
Yeah,
think.
I think that's good, and you should keep doing it and just keep trying, keep learning, keep improving. Just, I guess the main thing is just keep being objective about what's working and not. And some people skip that step. And so,
And when you lose multiple times on, let's say, same logic, you should definitely stop doing that
yeah.
or
Or
start
like,
shorting that.
or yeah, or like at least you could start like betting a lot smaller. So
Yeah,
I've tried buying like corporate bonds a bunch of times or shorting corporate bonds. And I don't bet like a lot, but I'll bet, 1% on a bond, which is a really small bet, right? These things aren't volatile. And dude, I just get massacred every time I'm wrong. And I just now I've gotten to a point where I'll keep trying once in a while. I'm like, no, it seems interesting. And I'll bet real small and it'll just go wrong again. But you're learning for a token small bet, and that's a good thing actually. And basically, what I've learned is I'm probably suck at bonds, but for like corporate bonds, yeah,
yeah, and then you see high yield bonds with really interesting dividends. So
yeah,
it's 10 times or even more larger than the stock market. So there's a lot of interesting thing going on. But I mean, uh,
yeah. I want to back a guy who does bonds because I'm not good enough at it myself, but that's a long short bond guy. Like he could have like someone who's really good at that. I read they can have like a single manager guy could have like a 2.5, or even the best guys, single manager will have a 3 sharp, and this isn't a quant strategy. And then this could be like a long short bond could be uncorrelated to anything that I'm doing. So actually, I'm really eager to back a long short bond guy who has like a 2.5 sharp. And then, I'd give him like a lot of the fund's money if he kept doing well. And now just that's the kind of thing we can improve the fund sharp to over 4 easily then.
yeah, because you can give a lot of money to bond guys. I
Yeah, I'd
mean,
want to give him
much
like
more than the
40% of
stock.
the AUM.
Yeah,
And then if he was running like 300-400%, and then I'd want him to run with some market risk because he's teaming up with a den of short sellers. So then if the market's melted down and the bond guy lost, normally you'd think bond guy shouldn't lose like 10-15% long short bond guy. But in our case, it'd be like you should just sort of take that risk if you see these high edge long bond opportunities. And like we've totally got you covered. So, and then I think that kind of strategy, maybe he could crank out like almost every single month 1.5% return. And if that's the backbone, that becomes the backbone of the fund. And then essentially all of our beta junky melt ups when we're losing, when things are tougher, those drawdowns would just get chopped down by 40%. And then that's because I ultimately I want to get to a point where we're having like 5% drawdowns at the fund level or even
of
less.
course. Yeah,
And that's the goal. So that's
yeah,
the bond stuff is really, really interesting. And I also like that there's so few people like even trying to learn that game.
yeah, exactly.
What a contrarian thing to get into. Like if you're a young guy, like don't even look at stocks. If you can think in terms of bonds, go play those long and short. And in a small account like the interactive brokers, they don't give a lot of leverage. But a smart guy can just adjust for that, and you can like later on, I'll be on a bigger broker probably, and I can just then we can jack the guy's leverage up a lot too. And so Yeah, I don't know how to even find that person, but it's definitely very, very interesting to me.
It's a rare breed, man. A rare breed.
Yeah,
It was popular decades ago. Now nobody cares, especially post 2008. With
exactly. That killed the market, which that's
yeah,
why I think the opportunities are so good
yeah,
now, or yeah, probably now even because really you had the 0% fake market forever. There was very little reasonable, decent lending activity. And then COVID's policy of flooding the market so much created just like a wave of just nonsense, total garbage loans. You
yeah.
have all these sort of debt zombie companies that still exist from the ZERP stuff, though they're sort of dying pretty quickly right now. And then, yeah, and then I think it becomes a really interesting long short bond environment where there's almost nobody even doing it, probably.
Yeah, probably nobody's even doing it. I mean, probably only institutions that have,
Yeah.
a lot of capital. But from
Hmm.
the short perspective, I'm not so sure.
But that's a beautiful game because remember how we were talking how quants sort of changed the market and they're running circles around the fundamental guys and put a lot of them out of business and everything. Quants don't work on bonds. It just doesn't match. So there's not even really like at least the higher, shorter term trades on bonds. The bid asks are too wide. The liquidity is too weird. You can't really do that. So, that's why that space is super interesting. Yeah, I swear, I bet the guy could have 2.5 sharp there, and for a
Yeah,
single guy, that's incredible.
David, thank you, man, so much for this
Yeah.
conversation. I really enjoyed it, and of course, I hope to have you again.
Yeah, yeah. Anytime or not too often, but like, yeah, a
Of
few
course.
times a year, that'd be cool. I like chatting with you.
And I, of course, invite everyone to put comments, to comment down below, and to ask pretty much any question. If David doesn't have the time to answer it, we'll use it for the next conversation. So, again, thank you, David. Thank you, everyone, and see you on the stock market.
Yep. Thanks for having me, man.
Thank you, man.